New York Stock Exchange. The air frozen. It is the 29th of October, 1929. The Dow Jones Industrial Average is experiencing one of the most devastating crashes in human financial history. The crowd tramples each other in desperate screams, brokers' phones ring out but no one answers, and in a private office on the top floor of a Manhattan building, a figure stands by the window, cigar smoke curling from his fingertips. Jesse Livermore, the most awe-inspiring yet feared speculator of his time, had just completed an epic short. He did not cheer, did not rejoice, only a gaze as deep as an ancient well, reflecting the inferno of financial hell outside the window. What he saw was not the collapse of numbers, but of human nature blindness when greed builds the Tower of Babel, and madness when fear shreds it laid bare in the giant mirror of the market. He knew well that the abyss that devoured countless fortunes did not stem from some mysterious signal on a chart, but from the boiling blood and trembling souls of every participant. The pulse of the market has never been something that cold mathematical formulas can fully decode. Its core driving force is the torrent created by billions of individual decisions, collective energy, driven by greed to buy, and by fear to sell. Take a look at the global market meltdown in March 2020, as if it were shattered by an invisible giant hammer. The S&P 500 index triggered circuit breakers 4 times in just 10 days, with the VIX Fear Index soaring to historic highs. But on the edge of the abyss, a powerful countercurrent began to stir. Those calm minds who discerned the unprecedented liquidity signals from the Federal Reserve's unlimited QE, quantitative easing, policy, saw the massive value gap created by fear. They were not blindly bottom fishing, but astutely capturing the inevitability of the market sentiment pendulum, swinging from extreme fear to a return to the mean. Similarly, in early 2021, the core asset rally in China's A-shares, with stocks like Kuaishou, Mutai and Cattel reaching dizzying valuation peaks, was the collective frenzy driven by greed. But when the tide receded, these once mythical stocks faced a brutal valuation correction in 2022. The essence of market volatility is the eternal pendulum swing of human nature between the extremes of greed and fear. Understanding this is the cornerstone of piercing through the fog and identifying real opportunities. To identify sustainable trend directions amid the stormy waves of human nature, you need a pair of trained eyes to look beyond appearances and discern the true force driving prices capital. Jesse Livermore emphasized throughout his life. Prices always move along the path of least resistance. Where is this path opened? It is driven by the intentions of the largest forces of capital. Imagine a rushing river, its direction determined by the deepest and widest riverbed. In the market, this riverbed is the collective direction of institutional capital, sovereign wealth funds, and industrial giants, these whales. What you need to observe is volume, either footprints of real money flowing in and out. In 2023, the epic rise of Nvidia's stock price was no accident. As the AI wave swept the globe, its GPUs became the gold standard in the world of computing power, and sharp capital had already sniffed out the future. Every key breakout in stock price was accompanied by a significant increase in volume, irrefutable proof of large capital building positions and consensus accelerating. Similarly, observing the process in 2024, where international gold futures prices broke through $2.000 per ounce and repeatedly hit new highs, was not merely driven by geopolitical risk aversion. Behind this, global central banks, including China's, continued to increase gold reserves, combined with strategic allocations by large institutions to hedge against fiat currency credit risks, creating strong buying power. The true trend is the profound trajectory carved on price charts by the direction in which the whales swim. Catching a trend is just the beginning. Entering and exiting with precision is like finding the perfect surfing moment in turbulent waves. Livermore's life essence is encapsulated in the key point trading method. This is not a vague concept, but a clear beacon formed when price action and market psychology resonate at a specific moment. Imagine a spring that has been building up tension. When it finally breaks past its critical point, the force of its release is the strongest. The key point is when, after a long battle between buyers and sellers, one side makes a decisive breakthrough, causing a shift in the market's direction at the path of least resistance. It often manifests as long-term platform breakout. The stock price oscillates within a certain price range, digesting floating shares like the calm before a storm. Once it breaks the highest resistance level with significant volume, it signals a strong buy opportunity. In the first half of 2023, Tesla's stock price, after about 6 months of oscillation between $180 minus $220, broke the $220 resistance level with strong volume, fueled by unexpected quarterly delivery data and the market's enthusiasm for AI in autonomous driving, signaling the establishment of a new upward trend. Breakthrough of historical highs, lows. When the price reaches unprecedented highs or lows, it often means that old psychological barriers are completely shattered and new space is opened up. In October 2021, CATL's stock price broke through its previous high to reach a historical peak, marking the market's redefinition and unanimous recognition of the value of the leading player in the new energy battery sector, with the upward potential becoming clear. Breakthrough of important trend lines. A trend line connecting a series of highs or lows visually reflects market psychological support or pressure. A valid breakout indicates that the momentum of the previous trend has weakened or reversed. In June 2022, the S&P 500 index effectively broke below the long-term upward trend line formed since the March 2020 low, compounded by the Fed's aggressive rate hikes, confirming the deepening of the bear market. Identifying key points requires patience, waiting for price action itself to send a clear signal. Livermore once advised, never act prematurely, and never stubbornly stick to your opinion after the market proves you wrong. This means that when a key point signal appears, you must have the courage to act decisively, but when the price does not behave as expected, for example, a false breakout, you must respect the market and quickly cut your losses. This requires ironclad discipline, the first test of human nature overcoming the impulse of fear of missing out and the stubbornness of not wanting to admit mistakes. Each key point trade is a harsh test of patience, courage, and discipline. Even with the sharpest trend sense and the most precise key point detection, without an unbreakable fortress of capital management, a sudden market storm is enough to capsize the giant ship. Livermore learned through blood and tears, the best speculators are always waiting, always patient, waiting for the market to confirm their judgment. Do not fully trust your judgment before the market itself confirms your view. His legendary accumulation of wealth and eventual tragic end is the most profound testament to the double-edged sword of capital management. Modern traders must engrave defense into their bones. Never risk your entire fortune. The risk exposure of any single trade must be strictly limited. A common rule is that a single trade's loss should not exceed 1 to 2% of the total trading capital. This means that even after 10 consecutive stopouts, you will still have over 80% of your capital to continue fighting. The art of pyramid scaling. True profits come from scientifically expanding gains in the correct trend. Livermore's core strategy is, the initial position is established at a key point breakthrough, and when the market develops as expected and generates profits, forming paper profits as a cushion, additional cautious scaling is considered only when the price pulls back to a new, validated key support level or breaks through a new small platform, just like Amazon's stock price in 2020. After breaking above its pre-pandemic highs, every healthy pullback to important moving averages, such as the 50-day or 20-week moving averages, became a potential good opportunity for pyramid-style position scaling. The scale of scaling up should decrease gradually to ensure overall risk is manageable. Stop loss is the lifeline. This is the jewel of capital management. Your stop loss must be clearly set before entering the trade, typically placed in the opposite direction of the key point breakout, proving the breakout failed, or slightly below, above important support, resistance levels, leaving room for normal market fluctuations. Stop loss is not optional, but a hard and fast rule. Imagine an investor who went long on Tencent Holdings in 2022. If they failed to strictly execute a stop loss when it effectively broke below the important psychological level of HK $300, the subsequent decline would have been devastating. Stop loss is like the braking system of a car, not to limit your speed, but to ensure your survival while driving at high speeds. The most lethal opponent in the trading room is often not the candlesticks on the screen, but the reflection of yourself in the mirror. Fear makes you sell at a loss in the dark before dawn, while greed lures you to grab chestnuts from the fire at the tail end of the feast. During the epic crash of US stocks in March 2020, how many retail investors sold at the bottom in extreme fear? And when the market surged under the Fed's liquidity flood by the end of 2021, how many bought into the most inflated assets in the greedy rally of "this time is different"? Livermore observed, "An investor's primary enemy always lurks within themselves. The hopes and fears of human nature are inseparable. When speculating, if the market is against you, you wish every day would be your last. If the market is in your favor, you fear tomorrow's profits will disappear, so you exit too early. Fear prevents you from making the money you should. Successful trading must combat these two deeply ingrained instincts. To tame the beast called emotion, you need powerful weapons, a mechanized trading system. Convert your entry, exit rules, position sizes, and stop loss, gain standards into clear, repeatable written plans. Execute them like a machine when the system signal is triggered. The system is your anchor, preventing you from getting lost in the emotional storm." The power of a trading journal, beyond simple profit and loss records. After every trade, record in detail the market environment at the time, decision-making basis, was it a system signal or emotional impulse? The psychological state during the position, anxiety, overconfidence, and result feedback. Regularly review these logs, like a doctor studying medical records, to identify the fatal weaknesses in your emotional patterns. Do you become overly confident after a series of profitable trades, increasing risk, or do you rush to recover small losses with reckless trading? A journal is the scalpel for self-awareness. Preset fluctuation space. Acknowledge market uncertainty. Before trading, ask yourself clearly, if the market moves against you by X%, where X% is reasonable, based on the historical volatility of the asset and the distance to current key levels, will your stop loss be triggered? Can you handle the mental stress? If the answer is no, either reduce your position size or skip the trade. True risk control begins with the mental simulation you complete before pressing the buy or sell button. The truth of the trading world is, there is no holy grail, no surefire secret. True power comes from building a complete system and shaping yourself into the most stable, reliable link within that system. This requires you to forge all your previous insights, your understanding of the market's essence, the game of human nature, your sharpness in identifying trends, the direction of the whales, your precision in capturing key points, breakthroughs at the path of least resistance, your strict adherence to capital management, survival first, and your mastery of emotions, combating greed and fear, into a closed loop. Context assessment. What stage is the market in right now? Is it a clear trend period or a chaotic, consolidating phase? What is the direction of the major indices, for example, S&P 500, CSI 300? How is the money flowing in core sectors, for example, technology, consumer, energy? This determines your strategic tone: aggressive offense, cautious defense, or a temporary wait-and-see approach. Opportunity screening. Within sectors that align with the broader market direction, use the key point principle to scan for individual stocks or assets. Is there a defined platform breakout, new high breakout, or trendline breakout? Is the volume healthy? Does the fundamental or industry logic support the breakout? For example, the AI frenzy behind Nvidia's breakout. Risk calculation. An opportunity arises. Immediately calculate, based on your key point position, where should your stop loss be set? How much space is there from the entry point to the stop loss? Based on your single trade risk limit, for example, 1% of total capital, how many shares or contracts can you buy? Position size equals allowed loss amount, risk per share, point. Plan execution. Set clear entry instructions. For example, buy upon breaking a certain price. Stop loss orders must be preset. And initial target can refer to key resistance levels or calculated based on volatility. Then, like executing a military order, let the system take over. After entering, eliminate your subjective speculations. Dynamic management. After the market moves, manage positions according to your plan. If the trend is favorable, use the pyramid principle to cautiously add at new, confirmed key points, while moving the stop loss up to protect profits. If the trend turns unfavorable and hits the stop loss, exit decisively, without any illusions. If the trend is consolidating, hold patiently until you hit the stop loss, take profit, or a new key point signal necessitates a strategy adjustment. Review and improvement. After each trade, regardless of profit or loss, immediately record in your trading journal. Analyze in detail. Was the plan reasonable? Was execution on point? Did emotions interfere? Did the result align with the system's expected probabilities? This is the fuel for your evolution and iteration. The success of trading is the bloom of the system's power, catalyzed by the compound effect of time. Every trade that follows the system, regardless of profit or loss, strengthens your wall of discipline and sharpens your mental edge. A true trader is a loyal executor and relentless optimizer of their own system. The noise of the market never ceases, and the greed and fear of human nature play out in every fluctuating quote. Jesse Livermore's figure has long since faded, but the penetrating gaze he cast upon the essence of the market still shines like a lighthouse, lighting the way forward. The weapon in your hand is not a crystal ball that predicts the future, but a deep understanding of group psychology, a sharp tracking of whale footprints, the courage to pull the trigger when breaking key resistance points, a survival fortress built by ironclad rules, and the absolute discipline forged through self-competition. The ultimate battlefield of trading is not in the flashing screens of exchanges, but deep within the quiet of your inner self. When you can clearly hear the rhythm of your own heartbeat amidst the market's storm, and when every decision is based on cold, rational rules rather than boiling blood, you hold the key that opens the door to sustained profitability. This is an endless path of cultivation, where every candlestick's movement is an invitation from the market inviting you to join the great game of cognition, courage, and discipline. Are you ready?